Okay, so it's a couple of minutes after 4. So with your permission, I'd like to get started. I'll just introduce myself. I'm Sue Horton, and I had the pleasure of helping to organize this session this afternoon. I'm an economist, but I don't work on Canada specifically. So just let me give you some short introduction. Firstly, for those of you who haven't perhaps attended any of the CanCOVID talks previously, the CanCOVID was set up as a network to support networking, information sharing as the pandemic got underway, and people had to make new connections for this totally new area of research. And we are supported by the Chief Scientific Advisor to the government. I'm one of the 5 theme leads, and I'm responsible for policy and economics. So today we have 3 great speakers, 3 distinguished economists. You've seen their bios. Just briefly, Guy Gellatly of Stats Canada has been working on a recently published study called COVID-19 in Canada, a 1-year update on social and economic impacts, which has really, really interesting, very, very up-to-date information. So he'll be presenting some of that. Then next, Avery Shenfeld, who's the Managing Director and Chief Economist at CIBC Capital Markets, will speak. And I note he's won several awards for his forecasting abilities, so maybe he'll be able to tell us what the future holds. And lastly, but not least, Michael Smart, who's at University of Toronto and is co-director of a very interesting website called Finances of the Nation, and which works on fiscal and tax topics. So the title of The Most Abnormal Recession, I borrowed from one of Dr. Shenfeld's colleagues, because I think it's very apt. I mean, who would have expected the kind of mix of outcomes that we've seen in the recession, rich getting richer, but on the other hand, substantial anti-poverty efforts by the government, and very, very different effects across the sectors than we would normally expect. And of course, the trade-off between the economy and health has been bitterly fought over politically. South of the border, you'll perhaps remember, and I can't remember who the person's name, but some prominent politicians said, no, those people in those older citizens should be happy to die, but knowing that it's going to enable their younger people in the population to continue working in the economy. On the other hand, the view is that controlling the pandemic is essential for the economy to be able to grow and to succeed again. So anyway, so it's a controversial topic, and I hope you'll feel free to participate. If you would like to do comments, please put them in the chat. And at the end, if you would like to give your comments in person, you could feel free to put your hand up on the software, the Zoom software. And the way it will go is each of the 3 participants will present for about 20 minutes, and then that will allow half an hour at the end for discussion. So again, thank you so much for joining us. And I'm now going to turn it over to Guy Gellatly.
Thank you. Thank you very much, Susan, for the opportunity to be here. I very much welcome that. Good afternoon to everyone. I'm just going to quickly share my screen here. You know, it was interesting. I certainly, when looking at the title, you know, the most abnormal recession in Canada's history, I mean, it's one of those things that immediately jumps out at you, how different that last year was in many respects. Some context, I think, here is really critical. If you, I went back to the GDP numbers for 2008, 2009, the recession there. And we had 8 months there where we had kind of declining output, so month after month after month. And over that 8-month period, total output fell by about 5%. So if you kind of go back to February 2009 and go from there to those initial lockdowns that we all experienced in April of last year, that decline was 18% in kind of economy-wide output. So qualitatively very, very different than what we experienced previously. On the employment side, same sort of idea. If you look at, we had an 8-month run out of the labor force survey back in 2008 and 9, where there was a decline of about 400,000, the employment losses. Of course, if you look at February last year to April, I think we all remember those jarring headline numbers. The total decline over that 2-month period basically being about 3 million. So 1 million in March and 2 million in April. So we're talking about something qualitatively very different than the traditional kind of expansions and contractions around business cycles that we normally think of when we think of recessions. I mean, this is very much a purposeful policy-induced shutdown of large amounts of economic activity to deal with a public health crisis. And the implications of that obviously can be very, very different than sort of the traditional recession. I just noted I want to note the basic shape of these sort of changes in output and employment. You'll remember sort of kind of late in the spring, we had a kind of a sharp rebound in a lot of the economic data, really into the summer months as kind of things rapidly came back online. And then there's this sort of general smoothing or flattening out in those growth rates as we sort of get further on into the pandemic. And that's sort of, if you think about the Bank of Canada, how they discuss this, it's, the difference between that reopening and recuperation, if you will. And one of the things that I've certainly noted in discussion with others is that it went from very much kind of an economy-wide shock early on in the spring of last year. And as this sort of goes through, second waves and now into the third waves, it begins to look a lot more sector specific in terms of how it's affected key sectors of the economy. So I just want to note up front again, sort of the immense changes in activity. And I think, Susan, you alluded to this. There wasn't anything out there initially for that year that didn't react in some way, shape, or form to the challenges of last year. I mean, we all remember kind of spending, how we changed our spending patterns, spending a lot more at home, a lot less obviously at restaurants and in terms of travel services. Big movements in the spending numbers. I think we're all aware of kind of the run up in housing and the kind of the sharp increase in activity there that we saw. I come from a group that traditionally is focused on business investment, capital spending on structures and equipment, because that stuff tends to be really important for productivity in the long haul. That was pretty severely impacted in 2020 as well, as businesses started to scale back their capital plans. So my point here is there's just a lot on the radar screen here that was affected by the events of last year. I think if I want to go to a key point, it's that this notion of going from a kind of an economy-wide shock down to a sector specific. So these are sort of GDP declines initially in red, and then sort of kind of where we've gotten back to in more recent months. So, construction, manufacturing, where there was a fairly heavy rebound in activity, they're basically near or at where they were in February 2020. Retail trade had pretty much almost a V-shaped recovery because they did so much to kind of get their product and platforms online and moving that way that they were sort of back to where they started almost in the summer months. On the other hand, you have sectors, obviously restaurants, hotels, and airlines, where the structural implications of this thing are really, really challenging, very severely impacted, and that recovery obviously has been fairly muted there. If you look at food services, basically they're at 2/3 of their output when you kind of compare back to pre-COVID times. I'm just going to advance that. So the key factor, or a key factor in all of this, obviously, is telework capacity, certainly on the services side. So if you look at industries where you can kind of quickly get back to work, you get the high-paying services, finance, professional science and tech, all of that stuff ramped up very, very, very quickly. All of that has a very high percentage of employees who can work from home. Conversely, if you go down to the harder hit services like accommodation and food, you're looking at 5%, in terms of some of those initial estimates in terms of telework capacity. So a very, very different ballgame there, obviously, in terms of getting back. And that sort of sits behind all of the structural adjustment that we're dealing with now. And you can certainly see that in the employment numbers. So this is the big net change in total employment from pre-COVID, February of last year, up until March. So, what was 3 million jobs lost last April was 300,000 by the time we got all the way out to March. And of course, some sectors have seen some declines. Some sectors like professional and science and tech have actually seen some pretty good job gains. But accommodation and food obviously sticks out here as the big structurally impacted sector. And one of the things that we've been able to do with the labor force survey, obviously, is try to understand the kind of the socio-demographics of these job losses to the best of our, to the extent that we can through that survey. So we've added a lot of detail to that. This is very standard in terms of the age and sex dimensions that we collect information on from the labor force survey. My point here, young people, we talked a lot about young people early on in the pandemic as being severely impacted, and not surprising, obviously, given sectors where young people tend to work, right? We're talking restaurants, we're talking accommodation and food, the retail sector. Obviously home to lots of young workers, and those young workers have been slower to come back, obviously, as a group than what we call core age workers. That's the 25 to 54-year-olds amongst us, and older workers. So young females in particular are probably the furthest back from where they started. And you see, I think of the 300,000 net jobs lost up to March, about 122,000 are young women. So young people as a group are slightly over half. So, they might be 15% of the labor force, but basically they're more than half of the job losses at this stage. So, and I want to acknowledge the work that CIBC did on this, because they were, I think, among the first to note that if there's a real common denominator to the declines here, it's low-wage work. And they had a good report several months back where they made this. When we released the February labor force numbers, we did sort of a standard year-on-year comparison where we broke out all paid workers, basically kind of into quartiles. So, those that are earning less than $17.50 an hour on the low end, and those that were earning kind of more than $36 an hour on the high end. And if you kind of plot that big red line there is kind of the lower paid workers, sort of the bottom quartile. And, they bore the very heavy brunt of all of these employment adjustments. And if you get out, from February 2020 to February 2021, the losses for the low wage group, you're looking at basically about 800,000 in lower employment. Conversely, at the top end of the distribution, those who make more than $36 an hour, you're actually up about 400,000. So a real stark difference depending upon where you are on that spectrum. But obviously, kind of the common denominator here in terms of impacted groups is, and a lot of these workers are in those kind of high contact services. So, and also worth, I think, emphasizing here is what this, might mean in terms of kind of unemployment and unemployment transitions. We saw a real spike in the number of long-term unemployed, basically those 27 weeks or more. And this is a legacy of the initial lockdowns that happened obviously in March and April of last year. And the difficulty there is the longer those go on, and the more likely those temporary layoffs are going to become permanent. And lots of good research in that area about what that potentially means for kind of career earnings and even short and near-term earnings. So something certainly that we're kind of continuing to watch there. So that leads to sort of the next big question, of course, which is, obviously a lot of the kind of the heavy impact of this and what makes it so fundamentally different is that lower wage workers were hit much, much harder in this recession than we'd seen in past recessions. And it's those high contact forward facing services that have really borne the brunt of a lot of those losses. So this raises the question about, and Susan, you noted this too, those mitigation strategies, the policy response that went into play to deal with that reality. So this is from some of the national accounting kind of household income numbers. The two blue lines are basically, one is primary income. If you look at the second quarter, sort of midway through the graph, you see a big decline in primary income. Think wages and salaries, basically. As those lockdowns went into effect. Conversely, if you look up top, that's disposable income of households, and you see the big gain there. And that big gain is being driven by all of that money that flowed into the household sector from those programs. So a very substantial swing in those numbers because of those transfers. The red line is household final consumption, and because we weren't spending nearly as much as we typically do during the initial lockdown. So that led to kind of these widely reported savings rates and the spike of household savings. So 2019 is sort of the typical year in the lead up to COVID, where that savings rate ended the year at about 2%. And then you get into kind of what happened last year, peaking at 27%, almost 28% during the lockdown quarter, and still in double-digit range towards the end of the year. Now, the challenge with data like this is these are kind of capital H households. We're looking at households as a group, where we certainly learned from the labor force survey and other things that what we need is really granular data to understand these adjustments at a more detailed level. So we have been producing a range of experimental indicators that look at how these measures have impacted households at different levels of income. So this was one that was released in early March. And it gives you sort of the change in average household disposable income last year. So through the first, second, and third quarters, those are the blue lines. That line that juts way out to the right is the second quarter during the lockdowns, and that's because of all of those income supports that went into the household sector. The point of comparison here is actually the red line, which gives you what household disposable income would have looked like without those COVID measures. So you can see, all the way across the spectrum from low income households to high income households, they're all kind of benefiting from those adjustments. Although proportionally, the impact is obviously much greater, kind of at the lower end of the income spectrum. But that's sort of how it breaks out. We did something very similar for age as well, and you get younger people obviously benefiting disproportionately from these programs as well. So that's sort of the mitigation issue in a nutshell. And when you look at the impact on things like potentially on things like poverty and on income inequality, the basic what we saw from all of these data was that there was such a heavy mitigating impact of those programs that if anything, kind of as opposed to widening, a lot of those income measures were actually narrowing through the early pandemic period because of the government spending. And I think the only last point I'll make is that it's going to be very, very difficult, I think, to kind of fully get a handle on the kind of the structural impacts of this and the ultimate impacts of this of the pandemic on some of these measures until those support programs, both on the business side and on the household side, start to wind down. And that's obviously something that will be kind of keenly looking at sort of as this evolves, obviously. But I think, Susan, at this point, I'll end there and pass it on to my colleagues. Thank you.
Great, thanks, Guy. And thanks, I've noted there are a couple of questions already in the chat, but with your permission, we're going to hold those off until the other speakers have had a chance to discuss.
Sure.
So next, I'm going to invite Avery Shenfeld to present. And it'll just take a second to load his slides. Great, Avery, thank you.
Thanks, Susan, and thanks, Guy, for setting this up so well, because that was a very good look at where we've been. I'm going to try to take a look at where we're going, looking past the current wave. There's the wave, the third wave of COVID coming on our shore. We certainly know that that's going to do some economic damage in the very near term, but I'm going to focus on what happens as that wave fades off. And if you look across the global economy, we are starting to see signs of improvement. I like to be a little bit of a heavy metal fan. In other words, I like to actually not listen to Metallica albums, but watch heavy metal prices, industrial metal prices for what's happening, at least on the goods side of the global economy. And you can see on this chart, we've had somewhat of a recovery in WTI, that's oil prices, but a very strong acceleration in prices for copper. And if I had other metals on there, they look quite similar. Lumber, new highs there. That's really a sign that the goods part of the economy is doing quite well, even though the service side of the economy, the restaurants and so on, airlines, still struggling. A lot of construction going on around the world, a lot of goods consumption going on the world. So we're definitely in a healing mode for the global economy as we get further into 2021. But there's some noticeable differences in how different countries did last year and how well they're likely to do this year. And I think there's some important lessons to be learned by looking at those differences. So if we look at 2020, for example, you can see that this was a miserable world in which most countries declined in GDP. China managed to grow, but a lot slower than normal. But just take a look at some of the numbers here. I think there's some noticeable lessons. Europe had a tougher time getting fiscal stimulus together because, you know, for a while, it's each country on its own in the Eurozone, and some of the weakest economies don't have the fiscal room to spend a lot of money. You can see the result was their economy did much worse than Canada or the US. But another lesson here is look at Australia. Yes, a GDP decline, but a much smaller one. What did they do differently? Well, they actually took pretty stern measures early on to get COVID under control, and that let them sustain a reopening rather than doing what we saw here, which was sort of an on again, off again reopening. And if I had New Zealand on the chart, you know, they did very well in doing the same thing, and some other Pacific Rim countries as well. Even China, who's certainly civil liberties policies I wouldn't want to emulate, but they really used the crack the whip on government to isolate people who had COVID and had a much quicker rebound in economic activity than some other countries. So the lesson here is that there really wasn't a trade-off between COVID necessarily and economic activity. Countries that took tougher measures early on actually benefited by a more sustained economic rebound. Now, you can see the US didn't do as badly as Canada. And really that's a lesson that if you're willing to tolerate a much higher death rate, I guess you can keep your economy open. But I'm not so sure that history will judge that all that favorably. Now, if we look at 2021, we have the US outpacing Canada yet again. I'll talk about why. But countries that are ahead in vaccines are going to get a benefit, and the US is ahead of Canada. That's part of the story. But some fiscal policy differences also are going to matter, I think, for 2021. The story of this economic recovery, though, is going to be very much focused on what Guy talked about. And this is true for the US, for Canada, for Europe. It's that consumers didn't spend the way they normally would. So we talked a lot pre-COVID about the 1%ers, a lot of focus on the richest 1%. I'm going to focus on the 90% or so of Americans or Canadians who didn't lose their jobs during the pandemic. And so they continue to have money coming in. And in the US, they had multiple rounds now of government checks going to many households. And the result is that while Americans are typically running savings at, you know, sort of a little over $1 trillion on an annualized basis, they had an extra $1.7 trillion that they set aside because they couldn't spend the way they normally would. And that represents about 8% of annual income. That's just sitting there really to finance a spending boom. Now, they're unlikely to just spend all this money all at once, but as the COVID restrictions come to an end, we expect people to initially just go back to spending the same proportion of their income that they used to spend. And that's going to make a big difference. And maybe even saving a little less than normal because they have piled up some of these savings. So I like to say that people are dying to go to restaurants. They just weren't willing to risk dying to go to restaurants in the middle of the pandemic. But we're starting to see in US states like California, where COVID cases are much lower than they are here in Ontario, we're starting to see those wallets open up. We're starting to see more travel, even more hotel rooms booked. All of that is in Canada's future if we can get our COVID case numbers down, as we hope we will. The other big development in the US that COVID did is it elected a different president, because I think you could argue that Trump might have won, if not for bungling to some extent the response to COVID. And I quoted one of his speeches there where he said, COVID, 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 that's all anyone wants to talk about. Well, we have a new president who took COVID, I think, a little more seriously. That's helping get people wearing masks and so on where they need to, but also another huge round of stimulus. Now that's going to be a winner for the economy in 2021. But our view is actually that if anything, they overdid it a little bit. They provided so much momentum that we're going to find that the economy starts to overheat when we get into 2022. That's going to push interest rates up as the central bank tries to keep inflation at bay. And so we will crowd out, in effect, some private sector spending. We'll have higher interest rates, maybe a bit less business capital spending, of course, some more government spending. So it's a change in the mix of the economy. But some issue there that I'll talk about in terms of the size of that stimulus. Of course, Biden's also talking about some tax increases, some other items. The climate agenda is back. That has implications for Canada's energy sector, but also puts our energy sector on a bit more of a level playing field with the US. And the one item that I think, two items I think are the big challenge to Canada. One is that Biden seems just as protectionist to some extent as Trump. It's protectionism with a different flavor. It's called Buy America. But that means not buy Canada, perhaps on government infrastructure dollars at least. And also a change in immigration policy over the next few years that could make the United States more of a competitor when we try to bring the top talent around the world, even at our universities. If people can't get one of those visas to get in to teach at an American school, that opens up opportunities for Canadian universities and Canadian science institutions to hire the top talent. I suspect that under the Biden administration, the US is going to be a tougher competitor for Canada in terms of that competition for skill. But overall, we in Canada are certainly going to benefit from the US recovery that is very much underway already and being juiced up by all that stimulus that's been passed in recent months. One of the consequences of that, in my view, is one that the Federal Reserve in the US, which sets interest rates, is downplaying a bit too much, which is when you have this much government stimulus and this much savings on the side that could be plowed into consumer spending, could all of that end up being too much of a good thing? Could you unleash inflation in a way that we haven't seen since the 1970s? And I would argue that there is such a risk, because in recent business cycles, we never let the economy overheat as much as it might overheat in the next few years. This chart shows a measure that economists call the output gap. When the bar is positive, it essentially means that GDP or output is running above where it could be without generating pressure upwards on inflation. And when it's negative, it tends to put downward pressure on inflation. And you can see in this chart that under our forecast, 2 more years of good growth and really probably another pretty decent year in 2023 is going to have that bar be more positive. In other words, more pressure on inflation than we've seen since the 1970s. So the fact that we didn't see much inflation in the last couple of decades was in part because central banks raised interest rates enough to prevent the economy from overheating. I don't think that the Federal Reserve will let inflation get out of hand. I think what they're going to end up doing is raising interest rates beginning in the second half of next year. That's a lot earlier than they're saying, to try to choke off some of this inflation. And that's where the trade-off in the economy comes, because we're getting the benefits of all this stimulus on spending, but we're also going to have, I think, a little bit of an earlier drag from higher interest rates. had we done a little bit than if we had done less stimulus. But there is a risk that inflation heats up, certainly if the central bank doesn't respond by raising interest rates. And one reason why that's true is because in the US, like in Canada, the job losses were very narrowly concentrated last year in a handful of service sectors. And what that did was it meant that those people who were in industries that continued to do okay didn't see downward pressure on their wage rates. So if you look at the recession of 2008 and you look at the average wage gain of those who continued to be employed in that downturn, they went from getting 4 to 4.5% pay hikes down to only getting 2% pay hikes. And it took a long time in the subsequent recovery to get wage inflation back up again. That helped hold general price inflation down because businesses were hiring people on the cheap. We haven't seen that much downward pressure on wages because the industries that are still doing well, you know, the Amazons that need to hire truck drivers, for example, to get all those packages to people's houses, the manufacturers who are making the things that we're buying for our home offices and so on, they haven't been able to find workers at a 2% wage hike. They're continuing to give reasonable wage gains. So again, we're starting this recovery with a little more inflation pressure than we did after the prior recession. We do then think that the Federal Reserve will have to raise interest rates. I think the Bank of Canada will similarly have to do the same by the end of next year, but we're not looking for big interest rate hikes. Those of you who have a mortgage that will come due in the next few years, don't worry so much. One feature that we saw in the last business cycle that I think will be retained in this one is, simply put, it doesn't take as high a rate of interest to cool the economy off a bit and prevent inflation from taking hold as it did in the 80s or 90s. What this chart shows is where peak interest rates were from the Bank of Canada, that's the first two bars, the Federal Reserve, the Bank of England, and the Reserve Bank of Australia, just 4 different countries, looking at the cycle that started after 2008 compared to the one that started after 1990. In the 90s, those central banks had to raise interest rates to anywhere from 8% in Canada to over 16% in Australia. In the last business cycle, Bank of Canada only was able to take interest rates up to 1.75% before the economy started to really slow. The US only got to around 2.5%. So the peak rates of interest probably not going to be as high, but we do expect over the next few years to see interest rates start to move up as we come out of this COVID downturn. I think, however, that the Bank of Canada will not be in quite as much of a hurry because, unlike the US, we really haven't piled on as much stimulus in 2021 as we did in 2020. You know, both governments pretty much took the same tack in 2020, and it was absolutely the right thing to do, which is respond to the biggest economic shock we'd seen since the Great Depression with a no-holds-barred effort to let deficits go up, but put money in the hands of businesses, in the hands of households to make sure that we didn't have a massive wave of defaults. And both governments ran deficits in the vicinity of 15 to 16% of GDP. But look at 2021. Biden has essentially piled on enough new stimulus that the deficit is not going to come down, even though the economy is recovering. Whereas in Canada, the latest federal budget, yes, it did have some additional stimulus, but it's much smaller scale. And the budget deficit is going to be coming down in 2021. So we're not doling out as much fresh money to businesses and households as we did last year. Or as the US did. And therefore, that's one reason why our economy probably will underperform the US this year. In addition to the fact, of course, that the Americans are ahead of us in vaccinations and not suffering from the current wave that we're seeing in the COVID variants. But like the US, you know, Canadians also haven't been spending the way they normally would. Here we measured it in a way that many of you would be familiar with. We just measured what's happened to the money that people have in their bank accounts, you know, short-term deposits or short-term GICs and so on. That's up more than 20% from a year ago. Normally, those deposits would grow at 3 to 5% a year. So this is very unusual. And that is, again, the money that the 90% of Canadians who didn't lose their job have waiting to spend down the road as that economy opens up. And where this money is going to go is mostly to services, the things that we haven't been able to indulge in, whether it's travel or restaurants. We may not see that all come about until 2022, when we get the full green light on going about our daily lives the way we normally did. But even things like, we call them deferred essential services. Many people have been putting off going to the dentist. That actually counts as consumer spending when you do that. And when I've had my second vaccine, that's pretty much high on my list, is a trip to the dentist to get my teeth cleaned. All of that will show up actually in consumer spending numbers in the latter part of this year. So that's going to be really the big driver. We at CIBC surveyed Canadians to ask, what are you going to do with the extra money that you've saved in the past year? And people don't always answer truthfully or know what they're going to do. This chart shows the percentage of respondents who cited any one of these categories. So it adds up to more than 100% because people could check off more than one box. You can see travel is high on the list. Unfortunately, a lot of that will be travel outside of Canada, particularly next winter. And some people do say they're going to keep some of that money in savings or investment rather than spend it. But you can see there are those who are admitting, and I think the truth will be higher, that they may spend some of that money spoiling themselves or their families with some additional spending that they haven't been able to do in the past year. Businesses, however, also have a lot of money piled up. Some of that is government grants that they got to keep them afloat. They're not so eager to spend it. There's a Statistics Canada survey of capital spending plans, still showing that in most provinces, as we saw last year, capital spending declined in 2020. Most provinces still seeing a decline in 2021. So I think it's going to be a little bit later to show up. But the bottom line of all of this is that if we put everything on a common measure, and that's this measure called the output gap that I showed you earlier for the US, is where is this economy relative to where it could be without generating inflation? You can see that Canada had a bigger decline, and that Canada is going to get back to that zero mark or above zero, meaning that we're starting to actually overheat a bit, well after when we expect the US to do that. So bottom line is being later in vaccines, not so great. Having less fiscal stimulus this year, not so great in terms of the race of whose economy feels back to normal again first. I think the US is going to win that race. The only race that we won here is the race to keep people from dying of COVID. We certainly did a much better job on that front. I'm going to skip this chart in the interest of time. One of the things that's happened in Canada, interestingly enough, is we've seen the Canadian dollar rallying in the last few months. Part of that is the markets think that the Bank of Canada will raise rates first, which tends to push up your exchange rate. I think that's wrong. I think the Federal Reserve will end up hiking first because their economy is doing better. Part of it is also that when Canadians don't travel, we run a trade debt surplus in services because travel is considered a service. When we go back to traveling, we will return to having a big deficit on travel. Canadians travel abroad much more than foreigners spend money here. That will create a demand for US dollars, for euros as we travel, and perhaps a little bit of a weakening in the Canadian dollar when we get back to that. One of the things that people worry about is when the government did rush to the rescue of the economy, have we somehow dug ourselves a huge fiscal hole? And the next presentation is going to focus on that. From my perspective, I don't really think so. The way to think about government debt is not how much debt did we accumulate, because we never pay that back. The government lives forever, just keeps rolling over the maturities. What it has to pay is the interest on the debt. And you can see that Canada entered this pandemic with one of the lowest, at least for the federal government, interest as a share of GDP was actually quite low. And even with rising interest rates from here to 2025, we'll still have a much lower interest burden than most other countries now have, and much lower than we had in some past periods in the 80s and 90s, where it wasn't just one big deficit. You can see that the deficits in the 80s and 90s were not as big as a share of GDP as what we did last year, but we did it year after year in a period where interest rates were over 10% on what we were borrowing in many cases. And that's when we really dug ourselves a big hole where we had more and more of our tax dollars simply going to pay interest. This was a short-lived blow up in the budget deficit. If we look out 3-4 years from now, it's going to be a lot smaller, and we borrowed at a much lower rate of interest. If I have a concern, it's more at the level of the provincial governments where, you know, they've been running pretty big deficits too, and they borrow at higher interest rates. Looking out further into the future, is life as we knew it ever coming back? Or are we in a whole new world where life will be forever different because we went through this COVID period? My years of experience as an economist tells me that predictions that the world will never be the same are often overblown. You know, the world wasn't that different after 9/11, and people thought it would be. We ended up going back to building tall office towers, even though one got knocked down by a plane. We ended up flying again. We did all the things that we did before. How much of the legacy of our weird life of the past year will live with us? Well, I like to use a concept that economists call revealed preference, which is, what did people show they preferred to do when they had a choice? So if we go back to 2019 and the decade before that, around the world, people were showing that they preferred to spend more and more of their income on travel. So I believe that travel will come fully back for leisure. Maybe there'll be a bit of a legacy on business travel. We've got used to these Zoom meetings. We might use them as a substitute to some extent. Online shopping surged during the pandemic. Again, their revealed preference showed that people were gradually spending more of their money on online versus going to stores before the pandemic. So I suspect that online will retain some of its market share, but certainly not the crazy market share it's had in the past year when people were loath to go into a store. Similarly, for online banking, it's going to retain some of what it gained, but perhaps lose a little bit back to going to branches again. Working from home, for me, life has been miserable working from home. I don't know about you. I'll be happy to actually see people again in real life. But I think that also revealed preference tells you something about that too. Zoom is not an overnight sensation. It's been around for 7-8 years. We could have done this on Zoom before. Why did we go into offices? Because there are productivity advantages actually in having those conversations with people face to face, in even the casual meetings and so on that you can have when you're working together. We think that most people will end up spending most of their time back in offices. One difference may be a bit more working from abroad. That is, you might be in an office building, but in a different city, because the technology has shown that we can certainly do that quite easily. And if you want some proof of that, here's a chart from New Zealand. It's the last one I have in my presentation. It looks at, or rather one of the last ones, it looks at what people are doing in New Zealand. And it's actually a measure that Google tracks, because of course they track everything that you're doing when you've got your phone with you. They show that in New Zealand, when they had their first wave of the pandemic, they had a massive decline in people traveling to workplaces or retail outlets. But New Zealand got rid of COVID by an aggressive strategy, and life is pretty much back to normal. That is almost as much travel as there used to be to places of work or retail. And I think that tells us where we're headed when COVID fades here. Surveys of businesses also say that most employers expect to call people back to the office at least part of the time. So I don't think we'll be working from home forever. One of the things that some people did is they thought that, well, if I'm not commuting, maybe I'll buy a bigger house further away from downtown. Maybe that's a good idea. Let's move, you know, to Acton or to the shores of Georgian Bay and work out of my cottage. We've seen, in fact, in the last year, if you look at the Toronto region, houses in the suburbs or in the greater Toronto area actually outpaced gains in houses in Toronto. So the premium of being downtown actually narrowed. I think that is going to swing back as people start to head back to offices, but also because at some point, you know, the relative pricing shifts people back. And we saw that in Vancouver. There was a long period where Vancouver proper got so expensive that people continued to move to the suburbs. But when that gap narrowed enough, you've actually seen some period now where the city of Vancouver was gaining at the suburbs' expense. So again, I think if you've moved way out, you might regret that down the road. So what lessons overall did we learn? Number one, there was no trade-off between the economy and reducing infections. As long as you weren't willing to live with a massive death rate, essentially countries that took a sterner line earlier and brought the infection rate way down by maybe having their initial lockdown last an extra month, they more than paid for that in a more sustainable recovery than countries that use this on again, off again approach. To paraphrase a line that Stephen Poloz, the governor of the Bank of Canada, used, in terms of fiscal policy, if there's a big fire, don't skimp on the hose. The fireman comes with the big hose during a big fire. Fiscal stimulus, massive fiscal stimulus, did better at restoring economic growth than countries that kind of skimped on that. I think we will have to remember that inflation risks become a reality if we overstimulate. So that's a lesson we might learn in 22 or 23. And finally, the old Boy Scout motto, be prepared. We were obviously not prepared in terms of our stockpiles of PPE, in terms of the way our long-term care facilities were run, in terms of our research on vaccinations, in terms of Canada's own vaccine sector, for example. All of those things, I think, are lessons that hopefully we will have learned so that when the next pandemic comes, we're better prepared. And I'll just close by thanking any of the epidemiologists on the line here, because I've been reading a lot of what you've been writing in the past year. Fortunately, my knowledge of statistics has let me help understand a lot of what you're saying. And to the extent that the scientific community has been listened to by governments in Canada, which was not always, as you know, I think that helped Canada avoid some of the outcomes we saw in the US, where the scientists were listened to even less, at least under the previous administration. And the results in terms of deaths and illness looked a lot worse than Canada. So thanks for helping out on that front. And with that, I'll turn it back to Susan.
Thank you. I guess you could see why Avery has won awards for forecasting. I think some of his predictions, it will be really interesting to discuss those. So please feel free to add things to the chat. I guess towards the end of his presentation, he mentioned the fiscal hole. So I expect perhaps that's something that Michael is going to take up now. Thank you.
Thank you very much, Sue. You can hear me, right? I'm having trouble seeing my screen. Good. Thanks so much. Yes, it was a great introduction to what I'd like to talk about from both Guy and Avery. I'll focus on the fiscal policy dimension of this remarkable situation that we've been in. And, I mean, we all know that this has been a very special year, but I think until you look at the data, it's hard to comprehend the scale of what governments have done this year, particularly here in Canada. The kind of action that we've seen from Ottawa is truly remarkable in terms of the support that they've given to displaced workers and to others, the support they've given to firms that are in distress. Monetary policy has gone in directions that we haven't really seen before. That's not the government, but it's an important part of what we're doing to respond to the crisis. And of course, one bottom line of all of that is that the government of Canada is borrowing on a scale that we haven't seen since the world wars of the 20th century. So there's a lot going on here. I want to give you, just as Guy and Avery have done, give you a sense of kind of the scale of that by looking at some charts. And then I want to think a bit about the future and reflection on the extent to which there's kind of been a paradigm shift of how governments should respond to economic crises and what we'll see governments do in the future. So the first part of this is just how large, I want to give you a sense of just how large the government's response to the pandemic has been. I want to think a little bit about, has it worked? Has it been a desirable policy? And to do that, I'll offer you a version of some charts that you've already seen from Guy and from Avery, a kind of an event study approach, what economists call an event study. I'll look at the kind of just how big the things have been and how fast they've been happening. I'll show you charts of what's been happening over the crisis over time and compare it to what's happened in previous recessions. And the messages are pretty clear. This was a deeper recession, but a faster recovery than we've ever seen before. And that's had a real fiscal dimension to it. And then I won't read every word on this slide, but looking ahead, let's think about what that means for the longer run. And so looking at the evidence of what's happened last year, let's kind of bear in mind where it's going to take us in the future. So here's the first such chart. And so the way to read all this, these are the cumulative percentage change in these key economic variables since the peak before the recession. I'll compare our current situation in the COVID crisis to what happened in the financial crisis of 2008 and what happened in 1981. And so orange here is going to be always the current crisis compared to the previous two. These colors are not supposed to be associated with political parties, although perhaps in some sense, I should have thought of that in advance. And so the first story here is that GDP, this was truly a V-shaped recession. GDP dropped sharply compared to what's happened in the past, and it's recovered more quickly than we've seen in major recessions in the past. This takes us through to the end of first quarter 2021. We don't really have the data for first quarter yet, but based on a plausible forecast, it's possible that we're already back to where we were at the peak before the pandemic started at the end of 2019. So it's possible in that sense we've already recovered to where we were before. Now, this picture is a little different because it's from my colleague Tammy Shirley of Wilfrid Laurier University. I think Tammy might be here today, so thank you, Tammy. And this is about employment. Guy talked about this in detail. Employment has largely recovered as well, not to the same extent, and there has been a bit of a setback since third quarter of 2020. And there are other caveats too. This is in some sense a K-shaped recovery because as Guy very ably explained, not all groups have been able to recover their employment experience nearly as fast. So this is not the same good news story as the first chart, but there's a lot of good news in this chart as well in terms of how far we've come back towards the peak. Now, in terms of the fiscal dimensions of this, federal spending policy is a big part of what's been happening without question in this crisis. And so this shows you, again, the cumulative percentage change in federal expenditures from the previous peak. And we've seen a massive increase. It's just remarkable. It's flabbergasting to anybody who's like me looked at these data over time, that federal program spending is now double what it was. And the government was able to roll out the policies they did as quickly as they have. Now, in the case of federal spending, in spite of the recovery, federal spending remains very high compared to where we were in the past. This only takes us up through the end of 2020. And as Avery said, we will see some restraint in the coming fiscal year, but the government continues to spend on emergency measures much more than they were spending before the crisis. Now, here's the good news side of that. Federal revenues have already recovered to where they were before the crisis. And again, this is a remarkable recovery. A year ago, knowing what I did about the historical data, I expected an experience like this, where we would have a prolonged downturn in federal revenues and the deficits would continue to accumulate into the future because of it, particularly because of businesses reducing their corporate tax payments. That's not happened at all. In fact, revenues are fully recovered now. Now, a big part of that, a big part of the reason why is because workers and firms are experiencing their pre-tax incomes going up because of federal transfers, and they're paying some of that back in the form of higher taxes than before. But the story here is good news in terms of the future for fiscal policy. Revenues have recovered. Now, let me take a minute to think about what these numbers mean. I mean, I think the first question in the minds of many economists and many others are, the government's done a lot this year. It's to their credit that they were able to act so quickly, I think, in response to the crisis. Have we gone too far? And the answer to this is unclear, I think, but possibly yes. And so let me just show you two more of these pictures that speak to that issue. The first one here, a little bit small perhaps to read, is what I've done is taken from the national accounts earnings of Canadians, that's their employment incomes, and I've added to it the transfers that they receive from governments. And again, the yellow line shows you that earnings, including transfers from the government, went up sharply during this crisis. So in that sense, perhaps as some have suggested, we overcompensated for the loss in employment and the loss in income that Canadian workers experienced. We gave them more, particularly through CERB in the middle of 2020, than they had lost in their employment earnings. Now that has in fact come back to normal experience in a recession. CERB has been wound up. There are still enhanced programs for workers in place, paying more benefits than in the past, but that's kind of what you would expect to be happening in a recession, and the government is on track in those terms. The second component of this is corporate profits relative to the peak before the recession. And you'll see there, again, there's been a surge in corporate profits. That's largely due to government transfers, particularly the wage subsidies the government is paying to many businesses in Canada. And this, again, is truly remarkable. We expect corporate profits to fall during a recession, but corporate profits are now about 20% higher than they were before. They're about $10 billion a quarter higher than they were before. And so this is a truly exceptional recession. So how do we think about those kind of responses? You know, my attitude is to the first of these pictures, this makes a kind of sense to make these transfers. I don't think of these transfers to workers as overcompensation. I think of it as a situation in which we had a left of center government that saw an opportunity to make transfers to workers and Canadians in general with below average incomes. And they were able to do it in a way at a time when those transfers were most needed, and the potential damage in terms of productivity and employment that might be caused by government transfers, that potential damage was lower than at normal times because the economy was shutting down anyway. And so I think this figure makes perfect sense and can easily be rationalized. Now, I don't think the same about the corporate profits figure, to be honest. There's very little policy rationale for using government funds to increase the incomes of shareholders of corporations. And that's what the government is doing. They hope, of course, that wage subsidies are protecting jobs, but the bottom line makes it very clear that that money is going to corporate shareholders ultimately in the terms of higher corporate earnings. Now, you know, broadly, did they do too much? Did they do too little? Did they respond in the right way? We can never know. And I don't want to argue that there's a causal interpretation, that the recovery happened at the pace it did because of the stimulus payments. But one role of the government here is to insure workers against economic losses. They've done that very well. And another role, a macroeconomic role, is to insure the economy against the possibility of a prolonged downturn or a double dip recession. And again, I think there's no question that government policy moved us in that direction. And so we can rationalize, we can understand why government spent what they did. Now, of course, the long-term implication of that is that governments had borrowed massively, particularly at the federal level, and that the federal debt has risen sharply this year, reaching levels that we've rarely seen in proportion to the economy before in Canadian history. And so a lot of people are concerned about that. Common question is, how will we repay the debt in the future? What will have to change in Canadian spending and tax policies? And I want to suggest to you that it's possible that nothing will have to change. That in fact, we will never pay back the debt that the government has taken on during the current crisis. And the story here is just one about, you know, what it means to have a sustainable debt. And it's typical for economists to think of sustainability as meaning how large is the government's debt relative to the size of the economy. Why relative to the size of the economy? Because that's the best measure of what tax revenues governments can raise going forward. How big is GDP today and how much do we expect it to grow in the future is a measure of our capacity to repay the debt. So if you accept that notion of sustainability of the government debt, then the rest is just arithmetic. We're concerned about the debt relative to GDP and how it will change into the future. Now, the numerator in that calculation, the debt, is going to grow roughly in proportion to the interest rate the government pays on its debt. The denominator, the GDP, is going to grow at the rate that the economy grows into the future. Now, as Avery has pointed out, interest rates are very low today. We're hoping that GDP will grow at a fast rate in the future. And that means that the debt to GDP ratio is likely to fall in the future, even if we do nothing to try to restrain fiscal policy in the future. So we don't have to repay the debt. It will naturally fall as a share of the economy. And so here's just a couple more charts to let you think about that. This is the history of debt as a share of GDP in Canada right back to Confederation. There have been a number of periods in which we have taken on a lot of debt at the federal level. During the infrastructure boom of 1880, say to 1910, roughly, during the two world wars, during the 70s and 80s, whatever was happening then led to a big increase in debt. And then finally, in the current crisis, where we see this remarkably sharp increase in debt. Now, after all the previous crises, debt did fall as a share of GDP. And so it's interesting to ask how. And in this regard, the thing to focus on here is interest rates and the natural growth rate of GDP. So here I've just plotted again as a red line, debt to GDP. And I've marked the periods of time where the interest rate paid on the debt remained consistently lower than the growth rate of GDP in the economy. And that period is early in the 20th century. Of course, after World War II, the big post-war boom was a period of low interest rates and high GDP. And in both those periods, we had a lot of debt, and it naturally came down as a share of the economy because of that phenomenon of low interest rates and high growth. And so the story about how to shrink the debt really is one of grow the economy and hope that interest rates remain low. Now here, the real exception is the period of the 1990s, when we did see big fiscal restraints and a reduction in debt during a period of high interest rates. And that was policy driven. That was a period in which we saw real fiscal restraint. Now, the question to me is, do we expect that experience to repeat itself again? Many of the people calling today in the media, within policy circles, for policymakers to pay more attention to the debt and to be concerned about that, to think about the ways in which we can raise revenue or cut spending for governments in the future. These truly are Canada's fiscal experts. And many of them cut their teeth in the 80s and the 90s fighting the deficit and debt problems of the past. Now, these people are experts, and I don't mean to dismiss their advice. Many of you are familiar with the idea that generals are always fighting the last war. And the question I want to ask is whether Canada's fiscal generals are fighting the last war, that something fundamentally has changed, and that this phenomenon of low interest rates that we've experienced for the last 20 years means that we can solve this problem without fundamental fiscal restraints. And, in fact, that suggests that we don't have to worry about last year's debt, and we don't even have to worry about some small degree of continued borrowing going forward, that it may be possible for the government to continue to run deficits into the future that will still be sustainable. And it may even be desirable because it will allow the government to invest in things that Canadians need, to increase the consumption of Canadians in a way which is sustainable indefinitely into the future. And so the suggestion there is that the current low interest rate environment is an opportunity, and the government is right to take that opportunity to run more deficits into the future. And so I'll just point out that the budget that we saw last week is very much consistent with that thinking. That appears to be the thinking of Minister Freeland and people in Ottawa. In particular, the budget did not offer any hard fiscal rule. They didn't say we're not going to run deficits. They didn't even say we're not going to let debt to GDP ratio rise in the future. They just said we don't think it will rise into the future. And that's despite the fact that they promised another $100 billion in new spending over the next 3 years, and they haven't given any indication of how they'll raise revenue to pay for that additional spending. So that's the environment that we're in today. And I think there's some question, is this going to be the new normal in terms of how governments respond and the attitude that governments and all Canadians will have to government deficits and borrowing into the future? Now, I'm going to conclude here just for a couple of minutes with a few caveats to that pretty rosy view of what government debt and government deficits will mean for the future. I do think that we're on a sustainable track. I don't think we have to worry, but I think we should be thinking about what the government is doing and what the government is telling us about the fiscal situation. Certainly here, there's risk around these statements. Economists, all of us, even Avery, I suspect, are notoriously bad at predicting interest rates into the future. And so we don't know that interest rates won't rise in the future, making that interest rate versus growth comparison much less rosy than it looks right now. And that's a real risk, and we don't know how that would play out in terms of sustainability in the future. The second thing I will say is, even if I'm right and we never repay the debt that we took on in 2020, that doesn't mean it's free, because we're going to go on paying interest on that debt as we roll it over indefinitely into the future. And governments should not think that debt finance spending is free. They should understand that there's a cost, and they should think about intergenerational equity. They should think about the fact that much of that debt financed spending will be paid for more by future generations than the current generation. And that is sustainable. It may be desirable, but it does have an intergenerational equity perspective. And in particular, it makes you think that the government, as it announced last week, government spending on, say, childcare may well be defensible to finance that with borrowing. But a government that says it's going to increase benefits for people over age 75, well, that may be desirable. But doing that and financing it with a debt is simply a transfer from the unborn in the future to the elderly generation today. And that may be much less desirable. The last caveat that I'll mention here, I'll end with bad news, probably a bad strategy, but I'm going to end with bad news by saying that there are longer run fiscal pressures facing Canada related to the growth of healthcare spending and the overall aging of the population. Most of those will be at the provincial level, not the federal level. And that's going to be a much bigger problem than COVID looks like right now in terms of what it means for debt into the future. And so the provinces deserve a place in this discussion. And one of the questions we should be asking is, should the federal government be borrowing to fund its priorities today, or should they be setting aside funds for the provinces to deal with that looming crisis over the next 20 years? I'll stop with that bad news and with thanks very much.
Great, thanks. They're very thought-provoking. You didn't mention municipal, so maybe that's something we can get to in the questions. So far I have noted 4 questions in the chat. 3 were for Guy and 1 was for Michael. And I would encourage you also, if you would like to raise comments in person, please raise your hand and maybe Rosa will help me keeping track of that. So if it's okay, I'm going to read the questions that were first placed in the chat. Okay, so and the first 3 are for Guy. So Eleanor said, she really commented, it's less than not quite a question. It wasn't that workers didn't show up, but that customers couldn't show up when referring to the sectoral differences that occurred. And, I don't know if you want to comment, Guy, or if that's just sort of you would agree with that.
Oh, certainly a bit of that, absolutely. Again, it's such a unique and historic and unprecedented situation there in terms of kind of what that did to demand. I'm certainly mindful of how Avery pointed out this. It's not like we didn't want to go to restaurants. Simply, we judged the risk to be too much in that respect. So yeah, no, I mean that's it in terms of sort of how these adjustments are going to continue to work out in sectors that have been very heavily impacted there. And as I said, it's going to be difficult to assess that until we gravitate to whatever that kind of new normal actually looks like. It's encouraging to see the numbers that I believe, Avery, you had up on your screen about the responsiveness in New Zealand to some of these adjustments where sort of people go back to kind of life as it was. But it's going to be a real challenge to kind of figure out kind of, especially on the labor side, I think, kind of what sort of demand for particular types of skilled labor we're going to need sort of in a post-COVID world, depending on what those structural effects look like. So thank you.
Okay, so the second question again was for you, Guy, and was from Wade Swee, who said, how did the change in low-wage jobs differ in the current pandemic from past recessions?
Oh, it's an order of magnitude different in terms of the immediate impacts. I mean, that sort of discrepancy between what happened on the low end and the high end is pretty stark. I presented the employment numbers, but you get the same results if you look at kind of hours too. People who were towards the top end were working a lot more than they were. I think many can relate to this over the last year. Whereas those on the bottom end, even those who were working, there were many more without much by way of hours, although they were technically employed. So, when I've seen overlays where you kind of go back to, to the early 90s and to the early 80s into the, the recession of 11, 12 years ago now. And kind of all of the impacts, from layoff rates to hour adjustments, very, very different this time around on the low end. And, this notion of kind of scarring as we get out now, a year out, is, I think, certainly very much relevant, given that was such a disproportionate impact.
Okay, and so the third question again was for you, Guy, from Michael Scutrud, and sorry, I can't eat and chew gum at the same time, so I may have mangled this question. Anyway, it was in response to a particular graph that you presented that had some red bars in it on employment, and his question was, what do the counterfactuals on employment assume about labour market supply adjustment? Okay, and so how did CERB affect that, and in turn affect income?
You know, that's a good question. I don't have much to offer on that in terms of sort of kind of hard numbers, but, you know, it's certainly something that's discussed, the response, and it's often discussed in terms of kind of skill shortages and just difficulty bringing people back, given the nature of those support programs. And, you know, there's lots of factors there, but it would be very interesting to look at that sort of going forward to see, you know, if it's an immediate adjustment in terms of kind of getting people back, or if it's going to be difficult. And again, I think it sort of depends very much as to how this, you know, the pandemic itself evolves over the next little while. But excellent question. Thank you.
So I have another 3 that I've collected from the chat. So I think this one probably will go to you again, Guy, and it's about the increase in the well-paid jobs. Was that surprising, or was that simply a continuation of prior trends, do you think?
I think it was a bit surprising for most, although, you know, when you sort of step back and look at I had that work on that slide on telework capacity. So your ability to adjust quickly on the fly to a major shock in a world where we're so dependent on technology. So much of that happened so quickly on the top end of that, especially on the services side, that maybe looking back at it, it shouldn't be as surprising as it was, but it's still pretty striking to think at how kind of quickly, kind of after April, we were kind of up and going again in many sectors of the economy, including, you know, many services where traditionally there's a lot of face-to-face. So, you know, other than those things that basically have to be consumed person to person, it was something that I thought was very notable.
And if I can just intersperse a quick reflection on that, obviously the supply of skilled people, I would assume, is going up. I mean, if you look at the applications to graduate programs in university, I mean, I have been deluged. I've had to read like 8 times as many master's applications than I would have in previous years. So I think a lot of people have felt, young people have felt, you know, wow, this, you know, I'm not going to find the job that I want. I'm going to go and get some more skills. I was sitting at the Sandbox this afternoon with my grandson, and the guy basically said, yep, data analysis. I lost my job and we're going to data analysis. You want to comment?
Yeah, no, I think that's it. I have a colleague who's done so much work on the long-term returns to education. This was well, you know, prior to the pandemic, but you know, they're pretty striking when you look at those returns over the long term. And I think a lot of young people instinctively realize that. But in a world where it's not obvious where those kind of lower you know, kind of less university style jobs are going to be. I could certainly see the, you know, kind of the need to skill up in that sense and kind of get into the educational programs. You know, it's different. You know, coming out of 2008 and 2009, obviously, you know, we had a huge ramp up out west in terms of growth with everything that went on in the energy sector and all of the investment and construction that went out there. It created a huge number of jobs and opportunities. And, you know, sort of a big question this time around, I think, is, you know, where those growth opportunities, you know, both for the high skilled and for the low skilled are really going to be. And I think that's an open question.
Okay, great. So I've teed up a couple questions now for Michael, and there's one for Avery coming from the chat. So B. Tolley, I'm sorry, I don't know what your full name is, asks, what percentage of the sovereign debt is domestic versus foreign?
I haven't looked at those numbers for a few months, so maybe the other speakers, maybe somebody else will want to correct me when I'm done, but there's a couple of aspects to the story. So most of the federal debt is held domestically. It's held by people in Canada. But as the debt goes up, not surprisingly, that means that the foreign share tends to go up as well. So over the last 20 years, as debt has fallen as a share of the economy, the foreign share has fallen quite dramatically. In recent years, the foreign share has started to rise again. Now, the big difference for 2020, of course, is the Bank of Canada has engaged in this arena, and they've acquired a lot of federal debt. And so that's had a big impact on who ultimately, so this year will look very different than the past situations will. And I see Avery's got a finger up. I think he wants to talk.
Yeah.
Yeah, I'll just make a comment about that. Kind of an interesting development. We've actually had a long stretch where we've been running a current account deficit and therefore a capital account surplus. So we've been effectively borrowing from the rest of the world as a country for a long stretch, really back since 2008. The interesting thing is when we do that, so we owe mostly what foreigners are buying in Canada is government bonds at relatively low interest rates. So we owe more interest to the rest of the world. But if you look at what Canadians have been doing to their portfolio, they've been diversifying to buy actual stocks abroad, and Canadian companies have been buying companies abroad. You think of the Canadian banks, insurance companies, and so on. So overall net, we owe foreigners more than we did 10 years ago than we have assets abroad. But the things we bought had very high returns. We bought stocks, we bought companies. They bought bonds with very low rates of interest. So if you actually look at the annual flow, do we pay more in interest and dividends to the rest of the world than we receive? Historically, that was true, but recently, actually, it's now the other way. We are receiving more profits, interest, and dividends from the rest of the world than we're actually paying to the rest of the world because we're sticking them with these very low interest bonds and buying as Canadians, as investors in our pension funds have been buying foreign assets with better returns. So actually that foreign debt situation looks less worrisome. We're a net debtor, but on the flow of income, we're a winner.
And I'll just add to that those dynamics speak to the issue that Avery raised about the potential for government debt to crowd out investment in the Canadian economy. It's a sign that our capital markets are very well integrated into the world capital market. We would not expect a lot of crowding out. We might expect the government debt to have an impact on other aspects of the economy, like the exchange rate and the inflation rate. But the direct link between the government borrowing and Canadian firms investing is not what it was.
Okay, so another question for you, Michael, and this is coming from Michael Wolfson. So he says, how do your broad fiscal stories change, if at all, when you include the provincial government situations? And then relatedly, the federal government has been holding off on responding to the province's demands for greater fiscal transfers for healthcare. How would these possibilities affect your fiscal and economic growth expectations?
That's a great question, and nice to not see you, but at least read your words, Michael. So the charts that I showed on the overall macroeconomic aggregates, in particular, the impact of transfers on the incomes of Canadians and the profits of firms, that reflects the overall role of government, including at the provincial level. But what I showed you about debt was at the federal level, and I did not show you a chart on the provincial level. My sense is that some provinces are running large deficits this year. Provincial debts have risen, but not, of course, nearly to the degree that it has at the federal level. Most of the heavy lifting in 2020 was done by the federal government, as it should be. Their job is to worry about the overall macroeconomy and worry about transfers to individual Canadians. So I think that's right. In terms of what will happen in the future, it is true that the premiers are calling for major new transfers under the Canada Health Transfer this year. They did not win that argument. They didn't get to the front of the list of people to benefit from stimulus payments. And so we'll have to see what the future holds. But the long run story tells me that something will have to change. The federal fiscal situation should continue to improve over the next 30 years, while provincial finances get worse. And so provinces and federal government share all the same tax bases. And so at some point, we're going to have to ask, does that make sense? Should the federal government continue to occupy all that fiscal room and spend on its own priorities? If not, what should we see instead? The two alternatives, one that Michael has suggested here, is greater federal grants for things like provincial health spending. Another alternative is for the federal government just to get out of the way. What we used to call a tax point transfer, where the federal government would reduce taxes, at the same time encouraging the provinces to increase their own taxes. I think there's an argument that that should be done, and I hope the governments will start to look at that over the next 5 years or so.
Okay, so Ivan Young had a question for Avery, that you mentioned that the price rise in lumber and copper, and is it due to supply chain problems or a real increase in demand? Okay, and I'll tack on a question to that. So what's that going to do to our softwood lumber dispute with the US?
So, you know, when I took a lot of economics, but I always remember that little X, supply and demand, right? And so actually both curves count. And in this case, both curves are having an impact. So part of this is that there is actually a surge in demand. So particularly for lumber, I mean, US home building is doing really well. Canadian home building is doing very well. And part of that is by design, in effect. When the central bank cuts interest rates, they're trying to stimulate some interest-sensitive spending. And there's one of the most interest-sensitive sources of spending is home building. So it worked. The people who didn't lose their jobs, again, the vast majority of people have taken advantage of these lower mortgage rates. And also, to some extent, if you're stuck in your house, it's easy to start to think too much about, well, maybe I need another room. Maybe I should do an addition. Maybe I should buy a bigger house. So we've had the combination of all of this, low borrowing rates, to some extent, the lack of spending on everything else has caused a surge in spending on housing. So that's what's showing up in lumber prices, is a surge in home building. To some extent, a little bit of a disruption on the supply chain there. I would say in metals, it's more 50-50. Again, a lot of metals demand picking up as the global economy improves, but we definitely had some disruptions in mining activity around the world. You know, the workers sent home because of COVID outbreaks and so on. That is temporarily pushing up prices. So if I looked ahead, I would expect actually most of those prices to be lower in 2022. Even though the global economy will have heated up, we'll probably have higher mortgage rates, so maybe not quite as much heat on the housing side. And I think that supply will do some adjusting in most of those commodities. So I wouldn't expect these current peak levels to last forever, but it's helping Canada. And on the softwood lumber thing, I mean, the thing is right now is it's not such a big deal. We're getting plenty. They need our lumber, so they're buying our lumber to some extent. That's being tacked on to the price. It's not a big deal. We would still like, of course, to settle that dispute, because there will come a day when lumber is not so buoyant, and we don't want to be still operating under that issue. But there's a lot of other, unfortunately, Canadian US issues for the Prime Minister to deal with, including that Buy America issue, the issue with the Michigan governor who wants to shut down a key pipeline. So whether softwood lumber is going to be the one that Canada does the really hard press on, or whether we'll be devoting our attention to other things, you know, getting more vaccines and so on, I'm not so sure.
Okay, and Avery, another question, this time from Wade Sui, said, what's driving the asymmetry in, this is the debt holdings that you described, where foreigners hold Canadian debt, but Canadians own foreign equity, and why are other countries not doing the same?
So it really has to do with, it's very long-term development, but if you went back 25, 30 years ago, you would have seen that the big Canadian pension funds, as well as many Canadian retail investors, were basically grossly overweight in their own country. And there were changes in pension legislation that allowed for more diversity in pension fund holdings. There was the Canada Pension Plan, which used to just basically own a whole whack of provincial bonds. And then we basically increased our Canada Pension Plan payments So they were collecting more money, and we told them diversify their portfolio. So they were spending money everywhere but Canada. So partly it was a change in pension plan philosophy that was a big part of it. And also then a change in Canadian retail investors who decided, you know, I've got too many of my eggs in the Canada basket. Now, the question is, why don't international investors do the same? They do, but Canada is a pretty small slice of the global equity market. We don't attract that much of that. That's part of it. And part of it is because we've had big government borrowers who are highly rated, those bonds have had appeal around the world. So for example, our provinces do a lot of issuance abroad when the opportunity is there to borrow at a slightly lower rate. And by the way, they hedge the foreign exchange risk. So they're not, doesn't matter if the Canadian goes down, they basically hedged that risk away. But they were seen as attractive places to park money. So Canada's got a AAA rating, which is a smaller and smaller list of countries who have it. Our provinces are considered reasonably protected by the fact that they can get a lot of money from federal transfers if they run into trouble. So they were attractive high-grade issuers, and that's why those issues were snapped up abroad when we decided to borrow abroad.
Okay. Yeah. So Wade Sui says that, so thanks. The best investment in Canada is the government. I just wondered if it was more of a set, people were buying insurance, buying more safety, and we were willing to accept more risk by going abroad.
Yeah, I think there's part of that. Part of it is also that big central banks around the world used to hold a portfolio pretty much only of US dollars as their reserves. And there was, again, a change that started a little more than a decade ago, maybe 15 years ago, for those central banks to say, you know what, we'll hold some euros, we'll hold some Canadian dollars, some Australian dollars. So we had a lot of interest from big central banks. Part of my job was to go explain Canada to some of those central banks, what a Saskatchewan was, things like that. But we were seen as an attractive place also by those central banks to park money for safety. And you're right, part of it was that Canadians then were taking a little more risk in their international portfolio. But if you've studied Finance 101, you know that diversification is a way to actually reduce risk. So Canadians were actually reducing their portfolio risk by shipping some of their money to other markets with other types of companies.
Okay, and we have one last question because we're pretty close to 5:30. So this is for Michael. Michael Wolfson asks, following your previous response, if both the federal and provincial governments share all the same tax bases, why is there a need to transfer tax points? Does this turn more on the differential growth in expenditure needs related to population ages for the feds versus the provincial government programs?
I think there is a need for coordination in this regard, and there's two reasons for it. The first is that, you know, no government likes to raise taxes, but there are a lot of reasons why it's harder. So why are we talking, Michael's interested in these long-run spending pressures. Why am I talking about taxes? Because the question is, how can revenue be mobilized to deal with rising healthcare costs? And although no government likes to raise taxes, it's a lot harder for provinces, I think, than it is at the federal level. One reason is because provinces compete against each other. And we've seen lots of examples of that in Canada when Alberta has cut its taxes in the past or decided not to have a sales tax. The provinces next door to Alberta face problems. They have to have lower tax rates on their own basis as well. And then there's just a political dimension. It's so easy to look across the border and say, well, those guys are getting this deal, why aren't we getting it too? So it's hard for provinces to just unilaterally or even as a collective go out and raise taxes. I think they need encouragement from Ottawa. And it's not just that. In my view, you know, even if the provinces could be doing that, we would still like coordination because, you know, there are federal taxes and provincial taxes, but there's only one kind of taxpayer, and that's Canadians. And so we'd like the federal government thinking, okay, well, you know, how badly do we need that program X that's our spending priority? Do we want to raise taxes to do that? Or do we want to get out of the way, vacate the tax room and let the provinces raise that same revenue to finance their needs like healthcare and infrastructure? So I'd like to see that coordination happening to get both governments thinking it's really just one taxpayer at the end of the day. I'm not saying that the things announced in budget 2021 are not priorities. I think there is an argument for, say, a national child care program. A lot of those funds, of course, are going to the provinces anyway. I just want them thinking together, and I wish sitting at the table together and figuring it out.
Okay, so given it's almost 5:30, I'm going to do two things. Firstly, it's been great to have three economists with such broad understanding to discuss this and to respond to questions. And I'd like to thank all of our panelists for excellent presentations. And that's been just great on behalf of all the people who attended. And I'm going to also pass this to Rosa. Would you like to advertise any coming attractions?
Yes, we will be having our weekly speaker series on this Tuesday at 4 Eastern. It's just usually a half an hour, maybe a little bit more, given the presentation sometimes. And it will be by Dr. Holger Schuleman and Dr. Potty. So I hope to see you guys there if interested. Thanks.
And I think we have another couple of these workshops coming up in May and June, eh?
Yes, we do. And we will be sending those out via our CanCOVID emails and through our Slack channels as well. And it'll also be on our Twitter channels. Thanks, everyone.
Okay, and so with that, I'd like to thank everyone. It's been a really interesting afternoon, and see you next time.